All right, so today is May 3rd, 2023, and this continues to be a very exciting year in the market. We've had 2 years of excitement, and we're all ready for that to be done with. We're done with the excitement. We want just smooth sailing. But I can tell you that's not going to be coming anytime soon this year. Before we get started with kind of a market update, I'm going to have Drew update you on some on the bank failures that we've been dealing with these last couple months and how it's affected the market. Drew, I'll have you go ahead and
All right. Well, since we put together these graphs 2 hours ago, things have already changed, so we'll get into that. Um, First off, just recapping what happened with Signature Bank, SVB, and First Republic. Signature Bank had issues due to poor management, of course, according to a report from the FDIC. When interest rates started to rise, deposits started leaving. 90% of their deposits were over the FDIC limit. And they also had a little bit of a niche in having crypto deposits. So about 20% of their deposits were involved with crypto, but it was still seen as a traditional kind of bank run. However, the FDIC has agreed that their oversight has fallen short because of staffing issues. Everyone, including the FDIC, is having problems hiring, um, people. So that's with Signature Bank. That was one of the first issues that came up. SVB was, of course, another one. Their issues started with poor interest rate management on the reserves, forcing them to sell a chunk of their bonds at a loss, which caused worry with our clients and run on deposits. The Fed's investigation report came out as to what took place. Some points made involved the Fed itself, where supervisors were unwilling to be hard on the bank management when they saw problems arising. The Fed actually gave SVB management a rating of satisfactory from 2017 to 2021, despite repeated observations of weakness in their risk management. In the fall of 2021, the Fed did finally warn them about their strategy, and the bank still failed to fix the issues. So besides the lack of liquidity, proper governance, and interest rate risks that were taken, the report believes social media and technology played a role in the pace of the bank run, compared to the runs in 2008 that took place over days rather than what's been happening over hours. The Fed will also revisit the rules implemented in 2019 that lessened regulation on these size banks. First Republic shares plunged about 50% last week, down 97% year to date. Their issue stemmed from poor interest rate management on their loans. So they had a lot of 10-year interest-only loans with a low fixed rate that are worth a lot less when interest rates increase dramatically, a lot quicker than they anticipated as well. JP Morgan Chase is acquiring nearly all deposits and assets from First Republic. One reason they did so was the hope to take over the wealth management aspect for the clients of First Republic. And now JP Morgan also has about 17% of all deposits in the US are with JP Morgan. The FDIC took a huge chunk of the losses on the mortgage and commercial loans that First Republic had. It will use about $13 billion from the FDIC Deposit Insurance Fund, which is mostly financed through fees paid by the banks. Now, Schwab is one of our key custodians for your investment accounts. You might have heard about them in the news lately, but Schwab overall is a more diversified company in their offerings and has a lot more liquidity than these other regional banks had. However, stock performance has still been affected by the issues of other banks. The banking sector in general has been affected, with Schwab itself being down almost 35% since February 3rd, so the last few months. Earnings might go down for Schwab, but that doesn't mean your cash and investments are at risk. The CEO came out and stated there would be enough liquidity even if 100% of their bank deposits left. So they're in much better shape than these other regional banks. And you can see, early March, all these banks' performance dropped dramatically. Schwab dropped, but not nearly as much, and it's sort of stabilizing compared to the others. Other regional banks we're watching include Pac West, which as of 2 hours ago was up 5% for the day after dropping 27% yesterday. Now it seems like they're having huge issues. And John, I don't know if you want to chime in on that, but that happened after trading hours closed at 1 p.m.
Yeah, I literally just as we were preparing to start the Zoom saw the headline flash over that PacWest is looking essentially for a fire sale. So they might be the next bank to fall in from these rising interest rates. But really, the key here is to show you that Schwab is not immune to the effects of these rising interest rates, but has not it's not been affected to a crisis type level. And so that's why we're not particularly worried. It's going to affect Schwab's earnings, but I really don't care about Schwab's earnings. I care about their solvency because that's what affects you and your portfolios. And at this point in time, we're just not worried at all about Schwab's solvency, but you better believe we're watching it closely. All right, anything else to add on that point, Drew?
No, just besides Pac West, we're also, Comerica, Western Alliance Bank, and Zion's Bank have also been in the news the last couple of days. So we're just watching out.
Yeah. Okay. All right, great. All right, well, let's real quick before we start talking about where we're going, let's take a minute to just circle back on where we've been through this 2022 bear market. We are now in month 17 of this bear market cycle. And despite all the news, it's actually been a pretty normal type bear market. Here's kind of a review of where we stand and some of the Zoom calls we've had along the way. The initial phase of this bear market started in January of 2022 and bottomed out at the end of September of 2022. So it took about 9 months for the market to go from top to bottom. And from top to bottom, the S&P 500 was down about 25% during that 9-month period. Now, during that first 9-month period, we had lots and lots of these all-client Zoom meetings. In the beginning, I was telling you, hey, this is just a correction. Corrections happen all the time. And then after about 4 months or so, it became apparent that this was not just any normal correction. This was going to be more like a bear market. So we were letting you know in about May 27th, our fourth Zoom call of 2022, that, hey, now we needed to prepare not just for a correction, but for a bear market. Through July and August and October, I was talking about what you guys should be doing with cash, making sure that you had sufficient cash for your short-term goals, sufficient cash for any intermediate-term goals, and then making sure that you were aware that we were keeping enough cash in your portfolio to take care of any retirement phase withdrawals for up to 3 years. Then in October, we really felt like there was a buying opportunity, that the market had overreacted and was and sort of the peak of fear had arrived. And so we did a bunch of buying in October and advised you guys to do buying also and move any cash that you didn't have working for you, put it to work. And that was actually the theme of my January meeting, put cash to work. Then in March, we were talking about the bank collapse. All along the way, the market had been recovering from that point. And here we stand today, March 16th. We've recovered about 15% from the bottom. The market still stands down about 13% overall, but again, not disaster level drops, right? Down 13%. We stress test that all day long, no problem at all. And we are in the 17th month. So Where do we go from here? Well, I truly believe that we're sort of at an inflection point right now where we will either continue the recovery, which I think is the most likely outcome, or we experience a double dip situation. And I'll go into why that will be in just a minute. A quick review of some of the big strategy moves we made along the way. Back before this bear market started in December of 2021, we began to get concerned about an overheated stock market and the potential that if we did go through a stock market drop in a rising interest rate environment, that not only would stocks not be a good source of income for you, but that the bonds might not either. And so we made a decision to diversify the bond portfolio by selling off about 10% of the portfolio from bonds and moving them into structured notes. Now, all in all, the structured note strategy has been a okay strategy. It certainly didn't come out quite as well as we had hoped because it has not been providing the income cash flow that we had hoped for. But from a diversification and a principal protection standpoint, it was right on the money. So pretty good. You know, I give it a grade of B on that move. You know, if hindsight 2020, I would have just left it in cash. But you know, I think it was the right decision at the right time. So then after the 9-month decline, we made the call in September of 2021 as the market was bottoming out to again sell another 10% of the portfolio from bonds and buy stocks at that point. That was a tough call because we were selling bonds low, but we felt like we were selling bonds low to buy stocks lower. And that absolutely panned out because your portfolio has benefited from the rebound that we've had since October of last year, that big 15% bump up in the S&P 500 since then. But where do we go from here? Are we heading into recovery or are we heading into a double dip? So this is kind of what we're looking at. This is where we are in the cycle. All right, we've been through the expansion. We hit the peak in December of 2021. Now we went through the drop, okay? That top of the peak to the trough, that took about 9 months to hit that bottom, all right? And we're now sitting about a third of the way through a possible recovery, all right? That's how much we've recovered so far. Now, I think there's about a 2/3 chance, a 66% chance that this recovery continues through the rest of this year. And we begin to set new all-time highs sometime in the beginning of 2024. But there is about a 1/3 chance that we experience this concept of a double dip, where this was kind of like a false recovery. And let's talk about what would push us into this double dip situation. All right. But before I get into that, I want to talk about recovery periods. How long are you going to have to wait for your money to be back to all-time high values? All right, this is a slide I've been showing you guys for over a year now. All right, and it's the recovery period based on different types of market environments. All right, in a correction, which is a drop of about 10%, it usually takes about 4 months to get back to a new all-time high. Well, we moved from a correction to a bear market about a year ago. Okay, so now we're not even thinking about correction recovery periods anymore. Now we're thinking about bear market recovery periods. Now, in a bear market is where the market typically drops about 20%. It's just, you know, it's described by having, you know, quite a bit of pessimism in the market, but no serious economic problems. Okay, that has been the case until about 2 months ago, right? Until March, when we started seeing these bank failures. Now, in a typical bear market, you're looking at a recovery period of about 16 months. Well, we're 17 months into this cycle, so we would have expected an average bear market to have already recovered by now. But a bear market can take as long as 24 months to recover, which would say, okay, well, if this ends up being just a bear market and not a recession, we would expect recovery by the end of this year. However, we are at this inflection moment. this might move from a bear market to a recession. Okay. And if that is the case, we would be expecting recovery to take on average 2 years, which would bring us to the end of this year, but could be as long as 5 years, which was the case of the Great Recession. Now, 5 years is an extreme outlier as far as how long it would take to reach recovery, but we have one example of that in our history. Okay. And I don't think that problems of today reach the scale of the Great Recession or anywhere near that. But I think a reasonable expectation is if we do end up in a double dip situation and we move into recession, another 12 months to 18 months from today to reach full recovery is probably reasonable. Okay, so understanding the road ahead and when to shift strategy. All right, I'm very proud of this slide. I hope you enjoy it. This is an analogy that I've been working on. Okay, the U.S. economy is like a locomotive, right? Speeding along. And over the past decade or so, it's been speeding along faster and faster and faster and faster, okay? And that high rate of speed has caused what today we're dealing with, this high inflation, all right? The economy was overheated, all right? And in recognition of that overheating, the Fed has taken action over the past, 17 months now to try to slow down this economic locomotive by weighing it down with higher interest rates, right? Just like loading the cargo bays of the locomotive U.S. economy with higher interest rates to try and slow it down, in the hopes that the effect of weighing it down with these higher interest rates would bring down inflation closer to its target of 2%. However, so that was working just fine through most of 2022, all right? However, now in 2023, we're now looking at some additional problems. Okay, so here comes Silicon Valley Bank and Signature Bank, and they're like a car parked on the railroad tracks. Okay, and the conductor of this locomotive, which is the U.S. entrepreneur driving this train, is going, oh my gosh, there's a car on the tracks. I better pump the brakes a little bit in case this car doesn't move off the tracks before I get there, right? So the U.S. entrepreneur is pumping the brakes, trying to figure out what's going to go on with this bank. Well, good news is the FDIC came along and cleared Silicon Valley Bank out of the way, and the U.S. entrepreneur breathed a breath of relief, and the train could keep on running. Until, boom, last week, right? Then First Republic Bank drives up on the tracks. And the U.S. entrepreneur pumps the brakes again and goes, oh my God, I'm going to run into another obstacle. What should I do now? Okay, but again, the FDIC and JP Morgan Chase come along and they clear First Republic off the tracks. Now, it was too hot off the press for me to get into the slide here, but you can imagine now Pac West, has driven onto the tracks. And again, we're going, oh my God, are we going to crash? But it looks like very likely, along with Silicon Valley Bank and along with First Republic, I'm sure the FDIC and one of these big giant banks, B of A, Wells Fargo, JP Morgan Chase, Citibank, will want to swallow up Pac West. It's really a smoking deal for them. But looming also on the tracks right now is this new barrier, which is this silly debt ceiling crisis of 2023. And you can think of the debt ceiling crisis as this like stick of dynamite sitting on the railroad tracks, threatening to just blow up the railroad tracks, right? Which would cause the US economy to just completely derail off the tracks. And right now we're looking at a June 1st deadline for that bomb to explode. Okay. It is so ridiculously, extremely unlikely that this were to happen. It's in the news a ton right now because it's really scary and it makes for great news and great clickbait because it's a political, tool also. But I can tell you, it is extremely unlikely. And why is it extremely unlikely? Well, because this train that is the US economy has been chugging along for hundreds of years and has managed to continue chugging along through a whole lot of super duper scary things, and yet has managed to get through it and thrive anyway. And what are some of those things? Well, the tech bubble bursting in March of 2000, the World Trade Center attack in September 2001, the subprime crisis in 2008, the last debt ceiling crisis in July of 2011, the trade war sell-off in September 2018, the coronavirus drop in February 2020. All of these, I think we can all agree, were much, much bigger problems than what we're dealing with right now. And though all of them cause their own amount of financial stress, somehow, some way, this amazing economic vehicle that we have here managed to continue growing. Entrepreneurs continue to manage to create profits out of capital and labor and resources, and they will again. It's really just a matter of time. Okay. So what are we kind of looking at? Where are we at right now? As I said, it is an inflection point. I think it's still a 2/3 probability that the market continues to recover, and your portfolio as it is today is positioned for that recovery, right? We have a little bit more stocks than we would consider normal in anticipation of a continued recovery. And I think that recovery will come with a 15 to 20% upside over the next 2 years. However, there is a 1/3 chance that all of these problems that I just mentioned do cause this train to stop and maybe even reverse a bit, right? Causing a double dip. And that would encourage us to change our strategy. Now, the good news is that it's probably not a bad time overall to be buying bonds if we have to. So if I have to sell that 10% in stocks and move it into bonds, it's not the worst thing, but I'm not ready to do it yet. Okay. Bonds still have really good yields right now. And it's even possible that if we do go into recession, this crazy Fed might actually end up reducing interest rates down the road, which would only benefit your bonds, or the bonds that you own. Okay. I also think the Fed is done raising interest rates for 2023. I think inflation is going to continue to slow. And I think GDP growth is going to be low, but positive. Okay. We got kind of a sour GDP number just a couple weeks ago. It looked like the economy was only growing by about 1.1% in the first quarter. That low growth rate might continue for the second quarter and the third quarter, but I do think we're likely to head towards a more stable, reasonable 2 to 3% annual growth rate in GDP. And again, I think that is the more likely scenario than not. Okay, so now that I've kind of gone through all of that, my big takeaways right now are these regional bank crises. They do continue to be, barriers on the track, right? They are things that can cause problems going forward, but at least so far, we have been able to deal with that. Okay, we've been able to deal with that and avoid it. Okay. How long can this go on for, though, right? How many more banks can we bail out, right? The answer is probably a lot. You have to remember that, we bailed out much bigger banks than what we're dealing with right now, right? Back in 2008. The question really becomes is how much more debt could the US government take on before it begins to impact the US dollar? Okay. And there have been a lot of news articles recently about, again, I think it's a lot of fear mongering, frankly, and clickbait, but about, the world is going to move away from the US dollar as its reserve currency. Well, I can tell you, if we end up defaulting on the debt ceiling, or if we allow the debt ceiling to default on our bond payments or our Social Security payments or our military personnel payments, then it's going to have an effect on the U.S. dollar. It would be really, really, really bad. But again, I think it's an extremely low percentage likelihood that could happen. Schwab, so, if, and we mentioned this in a previous call, but somebody posted it in the comments as a question, so go ahead and answer it. But, if Schwab goes bankrupt, if the bank side goes bankrupt, okay, those of you that have the Schwab non-FDIC money market fund, those funds would be at risk. No other investment in your portfolio is subject to either TD Ameritrade or Schwab's solvency at all. Okay, it's just not an issue at all. The only one that is potentially at risk is money in the non-FDIC Schwab money market, okay, which is a specific traded position that you and I would have discussed buying for some of your short-term cash. And in our call last month, I talked about potentially moving funds out of there into some FDIC insured options. Okay. And I still think that's a reasonable idea. I think it's a reasonable move to protect short-term cash. Okay. All right. Let me go ahead and open it up to other questions. Well, actually, I'll go ahead and answer some of these other questions that are coming through the chat. Why aren't private banks bailing out banks instead of the government? Well, some of them are, right? I mean, JP Morgan Chase is bailing out First Republic, okay? Now, they're doing it with some help from the FDIC, but you remember, the FDIC is not funded by the government. The FDIC is funded by the fees paid by banks to participate in the insurance program, okay? So the government is not taking on debt to bail out First Republic, nor did they take on debt to bail out Silicon Valley Bank. In contrast, okay, in the 2008 crisis, yes, the Treasury stepped up and took on debt in order to bail out the banks in 2008. Okay, let's see, another question on here. Yeah, private banks gave First Republic $30 billion of deposits to try and keep it solvent. Yes, that is true, and I have no idea what how that kind of works out into JP Morgan's bailout. But all right, what other questions does the group have that I can answer? Please feel free to unmute yourself.
John, I have a question.
Yes, Barry.
Harry, I must tell you, I watch all of those scaremongering shows on NBC, CNBC, MSNBC, Fox Business, and everything. I have yet to heard them explain things like you do. Is there a reason why you're not participating on some of these programs? It seems that it would be good for your business, and it seems that you are the only one to explain things that I understand. And someone like myself who understands, I have to say, quite a bit, I just think you need to do something. It's a shame. It's not a shame. I'm glad that we have you here, but you explain things in a manner that is so clear. I don't know. I just think you need to look into that.
I appreciate that so much, Barry. Thank you for saying that. Maybe my next career will be as a pundit. Any other questions, or flattery, please.
John,
Yes,
so
Greg.
are we at the end of the rate hikes?
Yes, I absolutely think so. I mean, I would have preferred them end the rate hikes when Silicon Valley Bank collapsed in March. I thought the last two rate hikes were silly, but they're not. Okay,
We were on our way to a nice recovery earlier this week.
Yes, yes. So here's the reason why the Fed is continuing to raise rates. They are scared to death of a repeat of the 1980s, okay, which following Nixon taking us off of the gold reserve, right, it created a lot of havoc with US currencies and interest rates. And if you go back to some of my other charts that I've showed you, you can see that in the early 1980s, the rates were like all over the place, fluctuating between the high 20s to the low teens. It was a disaster. And we went through a period called stagflation, okay, where inflation was very high, but also the economy was shrinking and unemployment was very high. And that's called stagflation. Now, the Fed knows how to tackle inflation, and they know how to tackle unemployment. They don't know how to tackle both at the same time. So it scares them to death, okay? So the hawks on the Fed are very willing to raise rates now, okay, while unemployment is still very low, in the hopes that they can nip inflation in the bud before we possibly go into a recession. Okay, they're not predicting a recession, but they know that if it happens and they haven't nipped inflation in the bud, that they are at that point powerless, right? They don't know the formula to solve that problem, and it scares them to death. So that's why they're doing it. Again, I don't think it's necessary, and there's a lot of people out there that agree with me, but I understand why they're doing it.
One other question, John. You know, we've all heard the term stress tests when it comes to the banks. Was it a complete oversight when doing their analysis that they couldn't determine the types of investments some of these banks were in, and not forcing them to sort of unravel those investments before they actually started hiking rates? I mean, it seems at this point, you know, there's no way. I mean, sure, you can stress test, but you can't stress test consumer confidence. And that's going to be that seems to be the biggest issue when it comes to the smaller banks.
So that's a really good point. So there's a big political debate right now about who's to blame, right? And there's plenty of fingers pointing back and forth, right? Is it the fact that you know, they weakened the Dodd-Frank? Was it Dodd-Frank? Was that the rule, Drew? Dodd-Frank. Okay. Was it that they weakened Dodd-Frank and exempted all but the very, very, very largest banks from those stress tests? I think it contributed, but was that the cause? No, the cause was the managers made bad decisions, right? And entrepreneurs make bad decisions all the time. And we live in a capitalist society where the consequences are you lose your equity, right? You lose your equity ownership, okay? And so any stockholder in Silicon Valley Bank was wiped out. Any stockholder in First Republic Bank was wiped out. And looks like all the stockholders in Pac West Bank are likely to be wiped out too. And those are good natural consequences, okay? But we as a society have decided it's one thing for the stockholders to be wiped out. It's another thing for the depositors to be wiped out. And we don't want that to happen. And hence the FDIC and hence the layers of regulation, okay? However, you know, as politics shifts, right, and we go from Democratic administrations to Republican administrations, it is part of the Republican philosophy to have deregulation, right? And they believe that that creates more efficiency in business, which it does. Okay, deregulation creates more efficiency in business. It absolutely does. Okay, but it comes with the consequence of, hey, shit happens, right? And so it's our tolerance to deal with the consequences of those decisions, which sort of fluctuates. You know, we don't want to end up in a situation where it's capitalism on the way up, but socialism on the way down. Okay, and I think so far we've struck a decent balance, right? We're using the FDIC, which is a financial institution funded organization to resolve these bank failures so that the stockholders are wiped out, which they should be, but the depositors are not. Okay. So, again, there's plenty there to debate, but does it impact you or your portfolio? No, I don't think so. But we're going to keep an eye on it and make sure that it continues to not. Other questions? Okay, well, again, apologize for the technical difficulties. We will figure out what's going on with this passcode problem and fix it for next time. I don't know when our next call will be. It's always event driven. I wait until I have something important to tell you guys, and then I schedule one of these calls. And I felt like this was an important moment. We will keep you updated if there's a change in my view of the strategy and how we implement it in your portfolio. But for now, we are staying the course. Please, we will send out this recording. If there's anybody in your life who you feel like would benefit from this information, please forward on the recording to them. And if you have any questions on how any of this information affects your portfolio, please reach out. I am available. Drew's available. We can always schedule a quick call and just answer any of your questions. Know that we are here for you, and we'll continue doing our best for you. So thank you so much, everybody.